What's going on, my fellow wealth creators? Matty Guys here. In this video, I want to share some pretty frustrating data and charts regarding mutual funds. And I want to share this because there's so much money invested in mutual funds. We're taught to invest in them because the fund manager knows better than we do, right? Wall Street is going to be, we're taught that Wall Street is so much better at managing our money. We're too stupid to manage it on our own. So we need to give our money to these institutions, to these fund managers to manage it for us because we're just too dumb to do it ourselves, which is absolutely ridiculous. But what's really frustrating about them is that a lot of the times they don't even keep up with the market itself, which begs the question. It's like, well, if you're not going to outperform the market that you're trying to outperform, what am I paying all the fees for? Because guys, there's a ridiculous amount of fees that are involved with mutual funds. Not all of them, but a good chunk of them. And they're oftentimes not disclosed in a very transparent way. So you might think you're investing in a mutual fund that doesn't have fees, but they have lots of different ways, lots of creative ways of sneaking those fees in by simply calling them something else. All right, so I want to show you that. But it's like, we don't think that like a 1 or 2% fee, for example, like a management fee, like a 1% management fee or a 0.75% expense ratio is a lot. Number one, that's oftentimes not the only fee that we're paying. Okay, that's number one. Number two, that can actually add up to a pretty significant portion of our portfolio that's being extracted from us and given to Wall Street. For what? When we could actually just invest in the market ourselves, not pay any management fee, we pay a very low expense ratio, and just ride the market. Let's just let it do its thing long term, right? Why do we need these professional fund managers, these institutions that know so much more than us? Why do we need to pay them a bunch of money to underperform the market 9 times out of 10? Now, here's the thing. Are there periods of time where mutual funds will outperform the market? Absolutely. And I'm going to show you an example of that. But that's not always the case. They don't do it on a consistent basis, right? What happens when the strategy of the mutual fund changes when there's a new fund manager, right? And how do you know which mutual fund is going to outperform the market? You don't. We're throwing darts at a dartboard here. There's thousands of different mutual funds with, all different kinds of different, with strategies and whatnot. And we're paying all these fees for them to underperform the market a good majority of the time. Okay, so I want to show the data. I want to show some charts here to show you just how big of a difference the actual market performance is from some of these mutual funds to get you to question whether or not the fees that you're paying for these mutual funds make sense or not. And to maybe bring some awareness to the different types of fees that you might be paying that you don't even know you are paying. And then we're also, I'm going to show you a document directly from the SEC showing you how much just a 1 or even 2% annual fee, like if we were just combine all the fees, like if what you're paying in fees equals 1 or 2%, like what that does to your portfolio over time. And what's crazy is that we're the ones taking all the risk. We're the ones fronting all the money. We're the ones riding the ups and downs of the market. And yet Wall Street gets paid regardless. The market tanks 20%. They're still getting their fees, their management fees, and passing a lot of the fund expenses off to us, onto us. Like, so they're the ones actually making money. And here's a book I would recommend you. Actually, there's 2 books I want to recommend to you guys really quick. I will link them down in the description. It's 401 Chaos. All right, that talks a lot about the 401k, a lot of issues with it. All right, not saying not to do it. It's not specific financial advice. None of this. I'm just sharing my journey here, my revelations of these things. All right, so 401 Chaos is really good. It's where I got a lot of the information that I'm going to share with you today, but also I think it's called The Pirates of Manhattan, and by Barry James Dyke. Really, really good book about the history of Wall Street, mutual funds, and things like that. It goes through the .com crash and all that stuff. All right, and how Wall Street continued to get paid, made millions, hundreds of millions, billions of dollars in fees, while investors lost 20, 30, 40% of their portfolio. It's just ridiculous. But we take all the risk and they continue to get paid. You read those books, and I don't know, it got me questioning anyways, like, what are we paying these fees for? Because paying fees is not necessarily a bad thing if I'm getting a lot more value than the fee that I'm paying. But as you're going to see here in a second, a lot of times it's not the case, and it's very, very frustrating. All right, now, whoops, I did not mean to do that. Let me share my screen here. I want to show you this really cool website that I found. It's called Portfolios Lab. I definitely recommend it because it provides like an actual comparison of, you can actually do a comparison of a mutual fund and, well, you can do whatever you want, but in this case, a mutual fund and the actual S&P 500. Now, the first one I'm going to start with is the Fidelity Magellan Fund, and we're going to compare it to the S&P 500. Okay. Now, in this particular chart, the free subscription for this platform only goes back 10 years. I think that's plenty of time, enough time to look at this chart. And you can see a very, 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 very significant difference in the performance of the mutual fund compared to the S&P 500. I mean, this is a massive underperformance of the market here, of this mutual fund, where, because again, in this one, this is like the S&P 500. So if we were to buy SPY, which is the index fund, and pay only an expense ratio of, I think it's 0.1%, that's literally all we pay. And we don't have to be like some super smart finance person in order to figure out how to buy SPY. We open up a brokerage account, we can invest in it directly. This isn't super complicated, okay? But we pay a 0.1% expense ratio. That's essentially the fee that we're paying, minus any fees to make the purchases, okay? And this is this is what we get access to here, right? Like, obviously, we would have done so much better in the index fund than if we were to pay a bunch of fees to this mutual fund here to get exposure to the market, to have them try to outperform the market for us because they're so smart, right? Here's what's really frustrating for me about this is we're making these fat cat Wall Streeters rich off of their fees. They're making billions and billions and billions of dollars on these fees, yet they take no risk. They front none of the money, and they still underperform the market. They underperform the market here. Now, here's what's crazy, is there are time frames when they can actually outperform the market. And what I want to do is pull up a chart here of a specific time frame of this specific mutual fund, because this is a big one. This is the one that I think it was Peter Lynch managed back in the 90s, I believe it was, and he did really, really well. I actually have it in my notes here. Let me give you the dates here, and you can pull this up and confirm it for yourself. And actually, I think I have it in ChatGPT. I asked it what the performance was. Yeah, here it is. Here it is, guys. All right, so in the book 401 Chaos, which I recommended earlier, I'll link it down below. Okay, he mentioned the Fidelity Magellan Fund during a specific time frame. Okay, between 1977 and 1990, that's the time frame he was talking about. He was talking about the billions of dollars of fees that they collected for management. Okay, but in this particular time frame, this mutual fund actually outperformed the market. Okay, so from 1977 to 1990, right, the S&P 500 achieved an average annual return of approximately 11.4%, assuming dividends were reinvested. In contrast, during the same period, Peter Lynch managed the Fidelity Magellan Fund and delivered an exceptional average annual return of about 29%. That's pretty impressive. Okay, now if I'll see if I can confirm. So the problem with Portfolio Labs or Portfolio's Lab, I can't go back that far and do it like an actual comparison. However, we can pull this up on TradingView. Fidelity Magellan, yeah, right here. All right, and we can go back to that time frame, all right, and just get an idea of what it did. So, well, maybe not. Okay. Well, yeah, not really. Okay, we can't go back that far, unfortunately. So I'm going to assume that that was correct. All right, but let's say it averaged 20%. I don't know. Maybe it's not. Maybe it ends up it's not 29% average rate of return. That's really, really good. Okay, let's say it was 20%, 25%. In this particular case, for this time frame, it made sense to pay fees to a mutual fund because it outperformed. Okay, here's the problem. Does it do that on a consistent basis? Can we use this information right here to make a financial decision? Because remember, any financial advisor you talk to, whenever they show you charts and whatnot, historical performance does not indicate future performance, right? So if we go back to Portfolio Labs here and we look at the last 10 years, it's massively underperformed the market. So how do we know that the mutual fund we're invested in is going to continue to outperform the market if it's done so in the past? We don't. What does that mean? It's a gamble. We don't know for sure. So the question is, are we better off investing ourselves into an index fund like the SPY, for example, if we want to get exposure to the S&P 500, where a pretty significant return here. If we go, if we scroll down, I think there's more. They'll show like an average rate of return. There's a drawdown, volatility, diversification. I thought they showed like an actual average rate of return here just to make it easy. It doesn't look like it. Sharp ratio, dividends. Yeah, it's not, doesn't show it. That's okay. Not a big deal. I just want to see what the average rate of return is during this time frame. But obviously, like in this case, we would have been much better off doing the index fund, 0.1% expense ratio, versus paying a bunch of fees to the mutual fund. Because here's the next part, guys, is even though like the fund still did okay, right? You would be, your portfolio would be up. But let's look at what the impact of the fees are. Okay, and this is directly from the SEC, guys. And if you want this document, all you have to do, just type into Google, how fees affect investment returns. All right, look for the sec.gov website here. It's a PDF. You can go through this. And it shows you how significant the fees are when, like, over a long period of time. That's why like a 0.5%, 1% fee doesn't seem like much, but over a long period of time, it is pretty significant. Okay. I think there's, where is it? And there's some in here where it shows, yeah, here we go. Look at this, guys. Oh man, this is crazy. In 20 years, the total amount paid for a 1% annual fee adds up to almost $28,000 for a $100,000 initial investment. In addition, if you were able to invest that $28,000, you would have earned an additional $12,000, blah, blah, blah. All right. But that accounts for a 28% of the portfolio. I mean, that's just crazy. Now, if it's outperforming the market, maybe it's worth it. Okay. But as we can see, a lot of the times it's very, very inconsistent. So the question is, why are we making Wall Street rich with their fees when they take none of the risk? We take all the risk when we can outperform their mutual funds a lot of the time by just investing directly into the index. One of the quotes from that book, Pirates of Manhattan, that just really stuck with me is one of the fund managers he was referencing in that book said, if you want to get rich with mutual funds, you start one, you don't invest in one, right? It's very clear here why that's the case, is because they continue to get their billions of dollars of fees while we take all the risk, right? And then they underperform. Here's another example. Let me see. Let's go back to Portfolios Lab. This one was really interesting. We're going to compare GLD, which is the index fund for gold. And then we're going to compare one of the top precious metals funds. What was it called here? I got my notes here. It's called Evergreen Precious Metals Fund. So ticker symbol EKWAX. EKWAX. All right. Allspring Precious Metals Fund. All right. And then we're going to compare it to GLD. And I think in this comparison, it actually keeps up with GLD. But again, it's another example of the inconsistency of mutual funds. It makes it very difficult to make long-term financial decisions when everything is so inconsistent. Now, when we look at the 10-year performance of these two, they're kind of in lockstep. And actually, it looks like the mutual fund slightly outperformed GLD. So if you wanted exposure to gold, for example, and you invested in this mutual fund to do that, you would have been a little bit better off, at least on the surface. This does not take into consideration the fees that you pay in that fund. And if we were to pull that up, what are the fees for, what was it, EKWAX mutual fund? All right, I think it was like, what was it, 0.68%? I don't remember exactly what it was. All right, we could probably do some research on it. And the point is, though, mutual fund fees are oftentimes way more than an index fund, right? So it's going to be a lot more than GLD, All right. And in a second here, I want to show you just to bring awareness to the different types of fees that you need to look for with these types of funds, because they're often, again, not disclosed in a very transparent way. So you might see an expense ratio, management fee, and you think that's all there is. There are other fees and expenses involved with the fund that are passed on to investors as well that obviously have a negative impact on the performance of your portfolio with them. Okay. But here's the issue is let's see, in 401ks, he was talking about this particular mutual fund. All right. And let's see, the time frame that he gave was, yeah. So and I already verified this, the price on TradingView. Okay. Let's see. So that this mutual fund right here, okay, the precious metals one, in the first week of December of 2008, I'll just go ahead and pull it up. Why not? All right, so you guys can see it. So you don't have to confirm it yourself. Okay, I don't think I'm going to be able to get like an exact price here, confirmation on the price here, but pretty close. All right, January 2008. All right, let's go right here. Okay, he said the price of this fund was $71.76. All right, that's like right in this range, so that's pretty close. Okay. Nearly 3 years later, on the last week of December 10th, this mutual fund was at $88.08 for a gain of 22.74%. So if we scroll through to December 2010, we could see that it has gone up quite a bit, right around that $88 range. Okay. During the same exact time frame, GLD, the index fund, started at $88.58. So we can go to GLD here. Okay. January 2008, right here. Yep. So pretty close. What did he say? It was, yeah, like right around that 88.58 here. Okay. In that range. And then went to $138.79 during the same time frame for a gain of 56.68%. So if we go to December 2010, you can see it's gone up quite a bit. So there's a much more significant gain over that time frame. Okay, but again, you're paying all kinds of fees to the mutual fund, and it underperformed during that specific time frame. So here's the point: how do you make a long-term decision when there's so much inconsistency in the performance? Like, what are we paying the fees for if a lot of the times the mutual fund is going to underperform the actual index itself? And even if they keep up like this, you got a marginal amounts of additional growth. But then when you factor in the fees, did you actually get more growth, or would you have been better off investing directly in the index? It seems to me that the index fund is far superior than these mutual funds. One, because they're so inconsistent and they rarely keep up with or outperform the index they're following, and two, you have all the fees. And let's get into some of those. Let's see, where are those? You know what? I'm gonna share my notes here with you guys. Might make it a little bit easier. All right, so if you scroll up, these aren't even all the fees either. But we have sales and deferred sales charges. We've got like the sales load mutual funds. These, from my understanding, have started to phase out a little bit, where they charge fees up front and then they charge fees on the back end. All right, so you have what's called no load funds, but these are, oops, sorry, didn't mean to do that. These are very, very deceiving, guys. So let me highlight this a little bit more, and I'm going to do a full screen share. So is important to know because it can have a very significant impact on how much money we have when we reach retirement. I mean, ultimately, that's one of the main reasons we invest in these types of things, right? Is so that we have a good retirement portfolio so we can create income from it. But the question is like, are we investing that money the best way possible, in the most efficient way possible, or is there a better way? Right. So, like I said, this is not specific in investment, guys. Investment advice, guys. I'm not saying to go sell your mutual funds or to never buy a mutual fund. As I showed you, in some cases, it does make sense. But it seems to me that it makes much more sense to at least consider index funds to get exposure to these different markets because we pay far less in fees, especially when a lot of these mutual funds, these fund managers, can't keep up with or outperform the market. So what are we paying them for, right? So like what are we giving up 20-30% of our portfolio for if it's not to get an outperformance of the market on a regular basis? So anyways, this was really intriguing to me. It's really helpful for me in my own investment journey, I guess you would call it. So hopefully it was helpful for you. Would love to hear your feedback. Drop that down in the comment section below. Make sure you subscribe, hit the like button if you found this video helpful. Really appreciate it. And I will talk to you in the next one. To your success. Matty Ice is out.